Guys, volatility also, if you're a Forex trader, gold trader, index trader, doesn't matter. This chart should be on your watch list. This is the VIX. And it surprises me, not everybody knows about the VIX. I mean, the VIX is, to options traders out there, this is the holy grail, right? This is the dollar index for options traders, basically, right? Currency traders love looking at the dollar index. Index traders love looking at the S&P. Options traders love looking at the VIX. But every trader, there's two charts that I would ask you right now to add to your watch list if you don't have them already. You ready? Two charts, the VIX, and what do you think the other one is? Hint, it's not gold. The two charts that I would encourage you to add to your watch list are the VIX and the 10-year government bond treasury yield. These two charts, Raj gets it. This is it. This chart, so important. This chart, so important. If you walked into the stream today to say, I don't look at the VIX or the 10-year, I'm telling you, these are two of the most important charts in the financial markets. Doesn't matter what you trade. Both of them matter so much. Okay? Again, if you're a gold trader, it drives me crazy sometimes. People say, I only trade gold and I only look at gold and I never look at anything else. It's like, okay, fine. Like, do your thing, but why are you watching the stream? We're talking about fundamental analysis here. We're talking about what really is moving the markets. And I'm telling you, the VIX and the 10-year treasury yield, really important charts. I'll talk about both of them briefly. The VIX is important because it shows you, think of it as the fear and greed index in a chart. It's really important. When this thing is really low, what it basically telling you is that options traders who make up, there's a lot of volume in the financial markets that goes through options. Options traders are buying puts, they're buying calls, they're selling puts, they're selling calls. When the VIX is low, it's telling you that the market doesn't think there's going to be big moves. And when the VIX is high, it's telling you that the market thinks that the market's going to have big moves. And when I say market, I'm talking about specifically the S&P 500, right? Which is a good indicator of the risk on, risk off sentiment. When this thing is high, people are scared. People think there's going to be huge moves in the financial markets. And when it's low, people are cozy, comfortable, optimistic, think it's all going to be rosy. Right now, it's like that, right? Everybody thinks, it seems in the market's perspective, that everything is A-okay. Things are good, right? The economy's good. Fed's going to cut rates. Geopolitics are going to improve, etc. Outlook has really improved in the last, actually following the election. Now, I don't say that to say, oh, it's because Donald Trump won, that's why the world is going to be better. That's not what I'm saying. What I'm saying is that the election was a big uncertainty event. People were really uncertain of what was going to happen with the election. And then when that faded, now we've got this very low volatility environment where people feel, okay, we're pretty good. Stocks are going to likely move higher. Cryptocurrency is doing well because, again, the VIX is low. So when the VIX goes high, what you will say, I'll say this for the rest of my time as a trader, most people's strategies work really well in either one of these scenarios, and very few trading strategies, actually, I don't know of any trading strategies, work well in both. Whether you trade Forex, gold, doesn't matter. During this period of time, typically things trend slowly higher in the stock market universe, and currency pairs don't move very much, right? They do, but they don't move that much. When this period happens, stocks are usually cratering really fast. Crypto is cratering really fast. So if you're somebody right now and you're like, I'm making good money, I am riding the crypto bull, I am trading the indices long and I'm making money, again, typically your strategy is going to work really well in a low VIX environment. While we're talking about the VIX, I wanted to mention one of my favorite volatility indicators that I use for sentiment, the put-call ratio. Put-call ratio, as we have on the Edge Finder, basically shows you the volume of puts relative to calls in the financial market. Now, of course, the VIX is something that options traders loves, but even if you're not an options trader, you can still use the VIX and the put-to-call ratio to get an idea of what market sentiment is. I just showed you the VIX, which showed you when that spikes up, a lot of people are kind of fearful in the markets. And then when it's down low, people are pretty confident in the markets. But the put call ratio is really cool because what it does is it actually shows you in a more fine, granular way whether or not there's a high volume of puts or calls in the financial markets. This is one of my favorite indicators for sentiment. And if you don't already have a copy of the Edge Finder, there's a trial link down below in the description. So try out the Edge Finder, see if it's a right fit for you. Again, you can get 30 days access to the tool and try it out for yourself. All of these cool charts and indicators are something that we specialize here at A1 Trading on building. So check out our stuff. We'd love to give you a chance to check it out for yourself. Apply down below. If you're somebody who's doing terribly right now, you say, I need more volatility. I need big currency trends to take place. I need huge breakouts. I need gold to rip through the highs and make a more decisive move. Then you probably want the VIX to go higher, right? So my point is nothing works all the time. This is why drawdown is inevitable. Nobody's trading strategy works all the time. You can have drawdowns and they can be ugly if you risk too much. VIX is really important. Add it to your watch list if you don't have it. I'm telling you, it's such an important chart. It'll add clarity to why the market's behaving a certain way. If you're like, I don't know why the market's acting weird, you may have gotten used to one environment and it switched, right? It's absolutely an important chart to add to your watch list because again, people get really confused. I only look at one chart. Well, great. You're completely blindsided to what else is happening, what external forces are impacting your chart that you love looking at. So if you only look at gold, great. But you could get some really good insights by adding some watch list items to understand why gold may be behaving the way it has. Look at what you guys want to see why the VIX matters to gold, for example. Look at this. Up, up, up and away, gold was going. And look at what the VIX was doing at that time. You had a pretty elevated VIX, right? August, huge spike up. You had a relative high VIX compared to recent times. Gold's been less decisive with this fall off in the VIX. Uncertainty is a factor that helps gold. So when the VIX is low and uncertainty is low, gold doesn't do as well. Usually, not always. Right? So that's my thought. I just wanted to share that with you. The VIX is a really important chart. I'm an options trader as well, so I use it all the time. I like when the VIX goes up as an options seller because I can sell things for high premium. I can sell calls, sell puts for high premium. When it's low, strategies that typically work better for me would be being long the indices and trend following stuff, right? So just wanted to share that. It's a really, really fun thing. The other chart that I mentioned is the 10-year treasury yield. The reason this matters so much is this is the bond market trying to forecast what the Fed's going to do, typically, right? The 10-year treasury yield is how much money, how much return you're going to get by lending the government in the US your money. How much do you get per year? You get 4.275%, which is arguably a pretty decent return for a passive, return, just investing your money. That's a lot higher than it used to be. It used to be much, much lower. You used to stick your money in a 10-year treasury and get nothing. Now you get a decent 4%. Again, that's no effort, just 4% on your money. And you go on and do other things in your life. So my point is, when this rises a lot, that can tell you that people think inflation could be a problem. It tells you people think the Fed is going to keep rates higher for longer. And when it reverses, when it's going down, people think the economy might be cracking. The Fed may need to cut rates, right? So keep this also on your watch list. It is dramatically important for things like gold, things like currency traders, things like index traders. This chart is so important because the Fed matters so much to either putting the gas pedal or the brake pedal on the market. This is a good indicator of generally where they're going with that. I hope that was helpful to you. That's two charts that I think are really important to add to your watch list: the VIX and the 10-year treasury. The symbols to add to your trading view or MetaTrader or whatever you use is VIX and US 10Y. Thanks for watching this video, and on the screen right now, you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.